Testing, testing.
Test, test, 1, 2. 1, 2, test, 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 1, 2, 3, 4. Testing, 1, 2, 1, 2. 1, 2, 3, test, test, 1, 2. Test, test, 1, 2, 1, 2. One, two, 1, 2, 1, 2, test, test, 1, 2. Testing, test, test, 1, 2, 1, 2, testing, 1, 2, 3, 4. Testing, 1, 2, 3, 4. Testing, testing, 1, 2, 1, 2, 3. Test, test, 1, 2, 3, 4. 1, 2, 3, 4. It's a little better. 1, 2, 3. Test, test, 1, 2. 1, 2. Test, 1, 2, 3. slightly. Yeah.
Check 1 2 1 2. Check 1 2.
Do test 1 2. Sounds better. Not great, but.
Check 1 2 1 2. Check 1 2. 1 2.
I do. I do. Testing 1 2 1 2 1 2 3. Yeah, that sounds way better. What did you do in there?
I had to turn up the house and the wash.
Okay.
Check 1 2. Check 1 2. Hello. Check 1 2. Yeah.
Cool. All right. So I slapped this stuff on there. Do you usually open both for them?
No, usually they do it because this one we don't sit in.
Okay. Cool.
Apparently the AG can't work without her there, but unfortunately I can't work without her here. Okay, so we will call the meeting to order. Declarations of interest? None. None received in advance. Minutes of the meeting of February 13th. Carried. City Manager Office, City Treasurer and Finance. Item number 1, 2013, City of Ottawa Consolidated Financial Statements.
Thank you, Mr. Chair. I'm going to present the results of the financial statements for 2013 in a short presentation, and then we have our auditors, our external auditors, Ernst & Young, with us today. With us we have Deanna Monahan and Susie Gignac, partners at EY, and Dirshan Naidu, who's the manager on the audit. They're going to present the results of the audit after I make my presentation, and then we'll open it up for questions. So if you want to turn to the first page, just briefly an overview of the financial results this year. Just to start off with, there were two changes in the financial statements, items that impacted the financial statements significantly this year. The first one is that you'll see quite significant dollar amounts in these statements reflecting the assets that we're currently constructing with respect to the light rail project. So that's added many millions of dollars to the financial position of the city as the project has gone underway in 2013. And secondly, during this past year, there were some changes in accounting standards at the local government level, and we made some changes in the financial statements to reflect a different practice for recording government grants, such as gas taxes. And in terms of the results themselves, you'll see as I go through my presentation that our cash and investment balances are maintained, and they are at levels that are slightly above last year's. That's a good thing. The credit rating agencies want to see that we maintain our cash balances, that we have liquidity. Our employee-related liabilities for the first time in several years are not increasing. They're stable. The reserve balances in line with the cash balances have been maintained and are not being deteriorated, and our debt servicing remains manageable. As I've gone through this the last few years, I've taken a moment to give you an introduction to the financial statements and a bit of how that's different from how we do budgets. So the financial statements have certain terms that may look like something that we talk about during budgets but are quite different. There's a term called net debt. And what net debt is, that's on our balance sheet, which is our statement of financial position. Net debt is the difference between our financial assets, such as cash and accounts receivable, and our financial liabilities, which are primarily long-term debt, and it provides a measure of the future revenues required to pay for past transactions. So it's a net of our assets and our liabilities, financial. There's something called an accumulated surplus, which is essentially our equity. So that's the difference between all of our liabilities and our financial assets. And there's something called an annual surplus on our statement of financial position, which I'll speak to briefly when we get to it, but that number is quite different from what we call the annual surplus when we report to you at year end on the results of our budget. So starting with the impact of the light rail project on the financial statements. Since 2011, we've been incurring expenses on the project. In 2011 and 2012, as well in 2013, we've been acquiring land for the project. And prior to the start of the project in 2013, the start of the construction, we were doing design engineering. In 2013, the project started construction, and we made one payment to the proponent. We are also, through the process, the proponent keeps constructing the asset, and we make payments at intervals. not always as they incur expenses, but when they meet certain milestones. So from a financial statement perspective, we're recording the full value of the asset as work is constructed, whether or not we've made payments to the proponent. So by the end of 2013, the value of the asset on our books was $629 million. Contributing to those expenses were government grants, offsetting part of those expenses. The federal and provincial governments are paying us 80% of every payment that we make to the proponent during construction, to a maximum of $600 million each. So these results are quite significant in terms of the impact on our statements. Our total asset accumulation in 2013 for the city was $1.2 billion, of which the piece associated with light rail was $495 million. So it's a big number. And as the project proceeds, next year you'll see another $300 million in terms of value of this asset as the constructor continues to incur expenses. So our statement of municipal financial position is our balance sheet. These are the financial assets side. You'll see that we have $1.6 billion in cash and investments. That's up slightly from last year by $76 million. And as I mentioned before, that's a number that we want to maintain. Accounts receivable are up $149 million, and that simply reflects the value of the grants receivable on the light rail project at year end. The last line in our financial assets, which I wanted to point out, is our investment in government enterprises, and that's Ottawa Hydro. That's the value of the net assets of Ottawa Hydro, $381 million. So our total financial assets are $2.4 billion. The Ottawa Hydro investment, we record in our financial statements both the increase in the asset, the net assets of Hydro. We also receive a dividend. So reflected in the 2013 financial statements is the dividend that Hydro Ottawa paid us in 2013 with respect to their 2012 results, and that was $18.6 million. That's different than the amount that we received in 2014 recently, just over $19 million, which relates to 2013 operations. So on the liabilities side of our statement, our balance sheet, our statement of financial position, we have accounts payable and accrued liabilities, and similar to the accounts receivable increase, there's an increase here that reflects the amount that we owe the proponent in our future payments that we have not yet paid, and we only pay them, as I said previously, when they reach certain milestones. So there will be another payment within the next few weeks as they reach another milestone that would relieve this payable. We have a deferred revenue line as a liability. And what that represents primarily is development charges that we have collected, that we have on the books, and that we will apply to, it will become income in the financial statements as we spend projects to which we apply development charges. So we have used up those, we are using up those revenues, and you see the decrease in deferred revenue. There's also a change in deferred revenues because we've changed the way in which we count for federal and provincial gas taxes. We receive about $90 million a year in federal and provincial gas taxes. They're stable revenue sources. We are not at risk of having to repay them because there are many uses that we could use those funds for. We as a city use them for transit. So the amounts that we receive on an annual basis now, the $90 million, will become a revenue every year in the financial statements. Previously, what we used to do is we would take the money we have. If we had not yet spent it, it would be shown as a liability, a deferred revenue. And on the assumption that if we didn't find eligible costs to apply these to, we would potentially have to repay them. These are permanent funding sources now. We have a broad range of municipal services we could use the money for, although we use it for transit, and we have significant transit expenditures, so there's no risk of having to repay these funds, and they are now income. Finally, I wanted to speak to the employee future benefits line item. These costs are $436 million this year, and that's similar to the $433 million that was on the financial statements last year. These benefits include, they're benefits earned by employees in the current period, but not paid for by taxes or rates until future periods. For our budget purposes, we estimate the amount of cash we will need in each year to pay for these benefits, and we provide for that in the budget. These are the amounts we need each year are fairly predictable. But for accounting purposes, what we do is we look at what are the costs that we need to record as they are earned while the employee is employed, rather than when they're paid out, when the employee retires or becomes disabled. So it's a difference in accounting treatment. In the accounting world, we reflect it based on when does the event that occurs makes us potentially future liable for these costs. And that's what we record on the financial statements. In the budget world, we budget for the amount that we need in the year, in the future years, and it's fairly predictable. And I'll speak to net long-term debt in a future slide. So a summary of the balance sheet, shown on the next slide, shows our financial assets, which I spoke to earlier, which are $2.4 billion, our liabilities, which are $3.7 billion, and that includes the net long-term debt, the employee future benefit costs, and accounts payable. So the net debt, which is the financial assets less these liabilities, is $1.3 billion. That is offset by our non-financial assets. We have $13 billion in tangible capital assets that are available to service future generations. So the city's equity, our accumulated surplus, is the net of all of our financial assets and our tangible capital assets. It's an $11 billion net financial position. So on the liabilities, the long-term debt increased this year to $1.65 billion, and that is as per our various long-range financial plans that we brought to Council over the last 3 years. As we've said before, our debt is only used to finance capital assets, and when you look at the number in the context of the total assets we spoke about, which were $13 billion, it represents about 10% of the cost of the assets when they were originally acquired that we used to fund with debt. The debt issued in 2013 funded water, wastewater, and transportation services, capital infrastructure, and there was a small component issued for land acquisition for the light rail project, $33 million. Our principal and interest payments are constricted in two ways. Council has its own debt target of no more than 7.5% of tax-supported debt servicing. The amount against city's target of 7.5% is about 5% in 2013. There's a provincial limit, which is total debt plus mortgage payments, because these financial statements include Ottawa Community Housing. That measure, which is the provincial measure, right now is 7.5% of principal and interest against our revenues, and the provincial limit is 25%. So we're well within the provincial limit target for debt servicing as well. The statement of operations, which is our income statement, shows total revenues of $3.7 billion, expenses of $3 billion, and an annual surplus of $762 million. The statement of operations in the financial statements shows expenses for operations, interest expense on debt, and amortization cost on assets. The revenue side of the income statement shows revenues that support both operating expenses and the acquisition of assets beyond amortization. Revenue increases shown in the Statement of Financial Position this year are primarily associated with the grants that we've received and will receive for the light rail project, as well as the revenues for gas taxes, the change in accounting. The annual surplus shown of $762 million is not the same as the cash surplus deficit that we report at year-end, although those numbers are reflected in these financial statements. So at year-end, we reported that we had a small surplus on the budget for tax-supported services of $296,000 and a deficit on the rate-supported budget. From an accounting perspective, this annual surplus represents the amount of money that we've raised through taxes and user fees, water rates, and received through grants that are beyond the operating expenses, and the net amount is available to repay principal on debt as well as to buy new assets. So it's a contribution that will acquire new assets. So that's the distinction between the budget and surpluses we talk about at year-end and what this annual surplus is on the financial statements. And it's grown significantly this year due to the amounts that we've raised and received in grants to pay for the OLRT capital expenditures that are shown on the other part of the financial statements. In terms of the statement of operations and the breakdown of our revenues, our $3.7 billion, our taxes, fees, and water fees and user charges, they've increased about $80 million, consistent with the water rate and tax increases that we've budgeted for, and it also shows the assessment growth we're receiving. Government transfers, as I mentioned before, are increased significantly because of the light rail grants. Development charges are the amounts that we're bringing into to pay for growth-related projects. And the last item that's shown on as a revenue in our operating statements is the contributed tangible capital assets. So the value of the assets that we acquire from developers as developments come into stream are shown as a revenue in the financial statements because the money is then used to and reflected as an asset that we now own. And finally, the statement of operations, the breakdown of expenses of the $3 billion in expenses, you'll see is primarily salary and benefits and contracted materials. Those are the lion's share of the expenditures. What I did want to point out here is the interest charges on our debt, $81 million a year. That is less than 3% of the $3 billion a year in expenditures that we incur as municipalities. So very manageable debt servicing costs. You'll see a small increase in the interest charges. That's not because rates are going up. As we issue debt, and if we issue debt for 30 years, the rate we pay for that debt is fixed. It does not get refinanced. But debt interest charges did go up because we issued new debt during 2013. And finally, I just wanted to, before I turn it over to Ernst & Young, I wanted to point out that I do have the accounting staff here attending, and I wanted to say a special thank you to the people in accounting, led by the manager of accounting, Peter Mutatzos, who take care to make sure that the city's transactions, their financial transactions, are appropriately reflected in the accounts so that the public can have confidence when they look at our financial statements. The auditors have signed off, and they're the ones who make sure the debits equal the credits, and I think they do a really good job.
Good morning, everybody. And thank you for that, Mona, that last comment, because one of the comments I wanted to make was to acknowledge management and the finance group for all the hard work that they put into the preparing for the audit. We received full cooperation, and we are now in a position where we've substantially completed our audit, and just with a few items that are typical of finalizing financial statements once they're approved, we will be signing an unqualified auditor's opinion on the financial statements. This morning we're here to present our report. On page 1 we have our table of contents. It's really just to give you a highlight of some of the key areas of focus during our audit, and in the areas where you have critical policies, estimates, and areas of audit emphasis. Our report is quite brief, but we are open to any questions you may have. And with that, I'll pass it on to my partner, Susie Gignac.
There you go. Did it. Perfect. Thank you.
So do we need to work this for you?
If you don't mind, that'd be good. It's not very long.
Okay.
For sure. All right, thank you very much. Thank you, Mona and Marion. Pleased to be here today to walk you through our audit results, and at the end, as Deanna mentioned, we're open to any questions if you have any. So if we move through to slide 2. Slide 1 is just the table of contents. We'll walk you through our EY services and our audit results. So slide 2, we were engaged to express an opinion on the consolidated financial statements for December 31st, 2013, based on public sector accounting standards. And we also do audits of a number of other financial statements of the City of Ottawa related entities. We issue a written communication or management letter if we identify any significant control deficiencies as a result of our work, and at this point we don't anticipate issuing a letter this year. And we do issue a letter on independence just to indicate that we consider ourselves to be independent and have not identified any issues, and that's included in our audit results package. For a status update, the audit is progressing as planned. We are substantially complete. As Deanna mentioned, we have a few procedures which are always outstanding at this point and will be outstanding until Council approves the financial statements in July, at which point we will complete them. And we do anticipate issuing an unqualified audit opinion based on the procedures we've performed to date. For other services, we also translate the financial statements and the financial highlights, and that is in process at this point in time. So as far as our audit strategy, there were no changes to our audit strategy from our original audit plan. We looked at the entity level controls and concluded that they were effective for purposes of the December 31 audit. And we did perform a combined audit approach, so we relied on controls in areas of payroll and purchases, payables, and payments. We also relied on controls for the IT general controls over the SAP system, and we performed some detailed substantive testing, so detailed testing of specific transactions as well. With respect to our strategy, our materiality, we do review our materiality level throughout the audit. The materiality level is the magnitude of an omission or a misstatement in the financial statements that would be considered to actually impact or influence the economic decision of a user of those financial statements. So the materiality level is based on thresholds which there's guidance in the CPA handbook as to what those thresholds should be, and we are within the range at 1.25% of expenditures, or $37 million. Our testing is performed at thresholds well below the audit materiality level. We do specific transactional testing, and we have assessed the unadjusted differences that we identified during our audit, and they are not considered to be material to the financial statements, and as a result, we anticipate issuing an unqualified audit opinion. As far as our strategy, we do use specialists as part of our strategy, specifically with respect to employee future benefits, so that we have an actual internal actuary who looks at the assumptions and evaluation with respect to the employee future benefits. The critical policies and areas of audit emphasis, revenue recognition is an area where we put a lot of focus. This year there were 2 changes in accounting standards that impact revenue recognition. There was PS 3510, which is tax revenue. That did not have a significant impact on the city's financial statements. And PS 3410, which is government transfers, which Mona has spoken to, in that there were changes to the accounting within the city's financial statements as a result of this standard, and in particular, deferred revenue that had been recorded as a liability in the past was recognized as revenue based on the new standard. We put a fair amount of focus on tangible capital assets as well. It's a very large number in the statement of financial position, and we do look at the city's process for recording those assets as well as disposals and amortization of those assets. And we focused on the light rail transit transactions as well this year, and in particular the accounting of costs that have been incurred to date, and everything appeared reasonable from our perspective and in line with public sector accounting standards and the accounting policies. Other areas of emphasis, we do put focus on the completeness of contingent liabilities to make sure they are appropriately reflected in the financial statements. We look at management and legal counsel's assessments and confirm contingent liabilities. We look at disclosure of commitments. We review agreements to make sure they're appropriately disclosed in the financial statements. We look at the valuation of your investments and financial instruments and make sure that they are in line with public sector accounting standards. We confirm with RBC Dexia as well. And measurement of employee future benefits and related costs. As I mentioned before, we do have an internal specialist who is an actuary and reviews those employee benefit costs that are recorded in the financial statements by the city's management in line with the actuary, which does the city's valuation. In all cases, we concluded that the city's accounting appears reasonable and in line with public sector accounting standards, and that any unadjusted differences were not material. And with that, I will leave it open for any questions.
Somehow this way. There. Okay. Thank you very much. We'll go to questions, and I will lead off with one, and that's on disclosure of commitments. Does that include all of the land transactions related to light rail?
We review the commitments against the agreement, so it would include the light rail transit agreements as well.
Okay. How would you indicate agreements such as ability to use city land for a number of years into the future? How does that appear? That kind of thing. Land or air rights?
I don't know that the right to use city's land in the future is actually recorded as a commitment in the financial statements.
Okay, so it's basically only transfer of money commitments?
Yeah, financial related.
Okay. All right. Then the next question goes to Councillor El-Shantiri.
Thank you, Mr. Chair. And if I can go back to the staff presentation on, we'll start with slide number 11. Ms. Monkman, you talk about the interest charges went from 9 in 2012 to 81 in 2013.
It increased by 9.
Increased by 9?
Yeah.
Changed it from 2012 by 9.
It was a change of 9.
And when you talk about the hydro, is that the endowment we normally receive on our $200 million investment? Is that the number you quoted earlier?
No, the number I was quoting earlier were the dividends that we received from Hydro Ottawa.
On our investment, that
Yes.
we have the $200 million investment? No?
No.
Okay,
So there are two amounts we receive. We earn income on the $200 million. That's reflected in investment income in our financial statements.
And how much was that?
13 million. The amount that I was quoting was in addition to the amount that we earn on the $200 million Hydro Ottawa Endowment Fund, which are funds that we invest and earn income on, and it goes to support capital projects. We also receive an annual dividend from Hydro Ottawa based on the results of their operations. And in 2013 financial statements, that number was $18.6 million based on the 2012 results of Hydro Ottawa. So they declare their dividends after year end and then they pay us. So the amount in the financial statements for that was $18.6 million. In addition to the dividends, and in addition to the amount we earn on the Hydro Ottawa Endowment Fund, we also have an increase in the assets that we own because Hydro Ottawa earns income, and that is retained in their net assets, the amount beyond what they pay us out in dividends. So that was the additional increase in the net assets that you saw on that slide.
Okay. Thank you for clarifying this. And when we talk about unfunded liability for staffing, can you take me which liability, and we'll talk about the employee future benefit. So that almost we're right on there. There's a very little change. Am I correct? Is that on slide number 6?
Can you repeat the question?
Well, the question is, it has not been changed much on the employee future benefit like it's only a 3 million changes from the year before. Is that correct?
Yes, there's a net increase of $3 million.
But then if you go up on the top of the page, the accounts payable and accrued liability is quite a bit of gap. Can you explain to me that?
Yeah, the increase in accounts payable is due to the accounting for the Ottawa Light Rail project. At year end, the construction value of the project, based on the work that the proponent had undertaken, had an amount that they had spent beyond what we had paid them for. So the works that they had spent money on that we had not yet paid for, because we pay based on distinct milestone events. So at year end, there was a $178 million amount that we recorded as payable to the proponent that we will pay in 2014 when they reach the next milestones. So that's the increase in accounts payable. There's also an offsetting increase in accounts receivable, because 80% of that amount will be paid to us by the federal and provincial governments from grants. So not a significant impact on the financial statements from that transaction.
Okay. And my final question, when you talk about the gas tax rebate, you're saying that it's not expected to change.
No, both funds are now permanent, and the federal one is indexed as well.
Okay, thank you very much. Thank you, Mr.
Thank you, Councillor El-Santuri. Next, Councillor Aguilar.
Thank you very much. This is a couple of questions for staff as well. You had indicated during your presentation, Ms. Monkman, that our debt level was manageable. Can you remind the committee again what, under the legislation, how much debt load we're allowed to carry and where we currently are?
Yes. We showed that on one of the slides. Marion will find it. But the provincial limit is a municipality can spend no more than 25% of its own source revenue. So own source being the amounts that we raise ourselves, excluding government grants and development charges. So just the money we have ourselves from taxes, user fees, no more than 25% of that can go towards repaying principal and interest. The percentage that's reflected in our financial statements is 7.45%. So well below the provincial limit. Other governments, there are range. Usually you won't see more than 15% for a municipality, but we're in a very comfortable range here.
Okay, but we'll continue to accumulate debt, obviously. Are we retiring debt at a sufficient rate to keep us in that range? Like, what are the projections going forward?
Yes, on this particular one, when we did the transit affordability plan, and we updated it recently during the past year with the transportation master plan, we did the affordability. We looked at the total debt load in the next 20 years, and this percentage goes up to just over 8. I think it goes at 10% at one point, so still within the provincial limit. We also measured our own measure of debt, principal and interest, just the tax-supported piece, 7.5% being the limit. And within the next 20 years, we were staying at that 7.5%. There was one period in the 2022 period where we would go close to 8%. But we were still on both measures through the 20 and 30-year transportation master plan updates, the transit affordability, where we looked at all of the city debt for all of the city projects. We were staying within the 25% limit, peaking in 2023 at about 14% and then going down. The city's own limit, which is 7.5%, we were staying at 7.5%. There was one period around 2023 where we would be just above it, close to 8%, and then going down again.
Okay, because I'm going to your comment where you said we saw a little blip because the interest rates are going up somewhat. Are we concerned at all about that having an overall impact as we go with the 20-year projection?
No, we're not concerned with interest rate. What I was trying to say with the comment on the interest rate was we have an increase in interest expense as a municipality, $9 million, because we have more debt. But in terms of measuring it, we have more income as well. The city is growing, and the assets are growing. So these things are moving in tandem.
Okay. The other question more has to do with process. You gave us an explanation, I think it was slide number 3, about how net debt is arrived at, what that figure means. And you talked about taking into account our accounts receivable as part of that formula. Do we take into account 100% of our accounts receivable? Because we know that often there are things we simply can't collect. So how do we factor that into the process?
We make provisions for uncollectible accounts in the annual financial statements. So we make an assessment of what may not be collectible. They're not significant amounts. We collect almost all of our taxes. We have one of the highest collection rates in Ontario, if not elsewhere. So we don't have a significant uncollectible debt item, but we do make a provision. And so the calculation is, yes, total receivables after taking allowance for doubtful accounts against total plus total cash less total liabilities. That's the net debt.
Okay, thanks very much.
Thank you, Councillor Aguilar. Okay, next it's my question. So, if I may, on slide 8, in your presentation, it says, just a second here, we're just bringing up the page, that the net long-term debt increased to 1.65. On the presentation we have, it says million, but I believe you said billion when you were talking. I would think billion is probably the correct amount. The presentation that we're provided with, is that going to be made public? That'll need to be corrected? Okay. It's not out there yet, right? Well, maybe you just wanted councillors to think it was $1 million then, because that's what we all have. So I don't think you do. The rest of us don't. Anyway, if that could get looked after, that would be great. The question I have is along the lines of what Councillor Aguilar was asking. The interest that we're paying on our debt, you said, is currently around 3%, and I believe I just heard you say that we expect that to go up as high as 14% and then level out at around 7%. Is that what I just heard?
Not quite. The 14% that Ms. Monkman was referring to is how much interest and principal we're paying as a percent of our own revenues. She said that would go up to 14%. And that's against your limit of 25% that the province has established. Right now, our interest rates, we're still at the lowest interest rates we've had in 30, 40 years. So we're still able to take advantage of that. But we do see over time that interest rates will increase. When we do our modeling to look at what you can afford for interest rates, being accountants, we are conservative in nature, and so we always assume a higher rate than we're actually paying at the time. So we've built all of our models with about 5 to 5.5% as the interest rate. And historically, if you look, that's more or less what we would pay over a 20, 30-year period. So we have a fair bit of cushion in there in all of our debt forecasts as to how much we'll be paying in interest, because we've assumed that we'll pay a higher number than we're actually paying today. So we saw our interest expense, how much interest we pay, increase by $3 million. That's the 3 that she referred to in 2013. But all that reflects is you took on more debt in 2013. So naturally, you're going to have more interest to pay. So, but our assessment of the debt that this city has put on its books and what it plans to continue to put on its books as you start getting some of these major projects coming to fruition is still very manageable. You're well within provincial limits, well within your own council mandated limits as well. It rises, yes, it rises in the future, but along with that come all of the assets that that debt is being used to pay for.
Thank you. And we have to be aware that the future councils will have to pay this debt, so I think that's why many of us are asking questions on that. Could you put that 3%, the current 3%, in perspective for us? So, for example, the province, what would be the percentage of their interest on their debt, or any other municipality?
The province actually would pay the same or a little bit less. The credit rating agencies come in and they assess the risk in your debt. We have a very high credit rating with both Standard & Poor and with Moody's. The province has as well, because they're a province, have a high credit rating, and they can issue their debt at rates.
Sorry, let me stop you. I'm not asking about the interest rate. I'm asking about that 3% of the debt charge that's going towards interest. I believe other municipalities in the province would have a much higher percentage than that. Would I be correct?
The province definitely would, because the province funds their deficit with debt as well. But municipalities, we haven't done an assessment of other municipalities, but I would imagine they would all be similar to what we have. There aren't too many municipalities out there that have huge amounts of debt beyond, I think the only one I'm aware of is York is getting close to their provincial limit, and that's because of their development charge situation.
Okay, thank you very much. Councillor Wilkinson.
Thank you, Mr. Chair. Starting at number 4, and I'll work my way through a few questions I have. On the light rail, I remember clearly that part of the funding of this is being done by I think $500 million is being paid as part of the whole proposal, and we pay it back later. Is any of that $500 million in this part of it? Because what it looks like here is this is like the total cost to this date.
Yes. So the first line on this slide represents the asset. So ultimately, by the end of construction, this will be $2.1 billion, including its $300 million that we're repaying over time. So on the financial statements, what will occur is we will show over time an asset worth $2.1 billion, and we will make payments of $1.8 billion during construction. The remaining $300 million will be showing as an amount payable during the next 30 years. So the asset side will show the full value of the asset. Yeah. We will take out of our bank account and the provincial and federal bank account $1.8 billion to fund construction costs. The remaining $300 million we will repay over 30 years to the proponent to ensure that performance is maintained.
How much of the $1.8 billion is actually being done by borrowing as opposed to being paid from direct income of all the different revenue sources we have? I've done many, I know. Do you have any, roughly?
We had shown, I'd have to get the numbers here, when we went to council, we'd showed the amount of debt authority. I believe it's about $100 million over the course of the construction.
So, and some of that is DC debt, or is that the debt other than DC debt?
Primarily DC debt.
Yeah, okay. And the 30-year period is all, that interest rate will be set for the whole period, or does it get times when it changes?
No, those amounts are fixed, and we know what that is. That was built into the contract.
Okay. And then the other big debt one we have is Lansdowne. I didn't see it individually in here. And that, I think, is a 30 or 40-year debt that's already been let?
That has been let, and you secured that at 4.25% for 40 years.
And so that's set rate again for the whole 40 years?
That's for the full 40 years.
Yeah, and that is already showing in these figures here then. The debt figures we have now includes the Lansdowne debt?
Yes, it does.
Okay. Because those are the two big projects we're doing right now. The employee future benefits, we're adding to that still, which means that people are, even though we have budgeted and paid some out every year, is there anything other than the fire department that still has that accrual? Because I think we were trying to get it that we didn't have these things accruing anymore, because by changing a long-term disability and things like that to get away from it. What departments still are paying into that, or that we have to?
You're referring to a vested sick leave, where they get to accumulate sick leave and then take it out?
Or no, I know we have the employee future benefits are ones we have to pay at certain times. A lot of it has to do with payouts of sick leave when they retire and various other things. I think there's more than one thing in there. that was always a big part of it. And I know a lot of municipalities, I dealt with this many years ago, were trying to move to long-term and short-term disability so we wouldn't accrue these amounts. But we still have some that we're accruing in Ottawa, obviously. Is that I know the fire department's still that way. Is there any other department?
I'll ask Ms. Fredericks to respond to that.
Yeah.
So within this line, and I might need my finance colleagues to make sure I'm on the right track, there's, as you talked about, sort of those sick leave benefits that are associated with fire that are a negotiated benefit. But within here as well are some of the legacy pension plans that existed for OC Transpo and the City of Ottawa, former City of Ottawa. Those are now closed plans in that we're just funding and there's no ongoing contribution coming from new members. So it's a closed plan, so that liability is in here as well as any severance payments, etc. So there are a multitude of things, and on the long-term disability aspect, I think that funding provision, is that in this line as well? So that's an administrative services only, and we've maintained some reserves as well as projected as we look forward as to our utilization. So there's a number of components in here.
Yeah, I didn't realize that. The payments we're making on the pensions that are being paid out now, those are put in the annual budget, though, to pay, aren't they? So this year's payment, the liability shouldn't be changing. In fact, over time, those should decrease as people go off the pensions when they get to be 110 and they're not alive anymore.
You're true. That's absolutely right. The liability will decrease over time, but as you know, we have to have sufficient funds in the pension plan itself to meet all of those future obligations, and those are assessed by an actuary. And as a result of what happened in 2008 with the financial markets, all the pension plans in this entire North American continent went into what was referred to as a solvency deficit. So we are still making payments toward those solvency deficits. They are reducing, though, over time. But you're absolutely right. Because they're closed pension plans, the liabilities will decrease over time. We're just not seeing it at this point because even though the liabilities are decreasing, the assets aren't at the value they need to be to fund the existing members.
I know. I've seen that in the operating budget we had to put over 5 years, I think. And don't they periodically review those to see that changes what you have to add in?
We actually review it every 3 years, but we only have to file every 3 years, and you only want to file when you have good news to report. So we have to file, I think, in 2014 for COSF, and OC Transpo, I think, is this year as well. So we should have some good news, we're hoping, because we'll be filing, and hopefully the payments will be decreasing as opposed to increasing.
So that should change over the next few years. We should see that future benefit line going down a little bit?
That is our
I know there's more things in
but
it,
a large part of it is dependent upon what happens in the financial markets, because those assets are all invested and need to make a rate of return that's sufficient to offset increases in liabilities.
So you never can quite guess. Okay. Yeah. I think it was in number 8, the next one. The debt that we added in was from a number of different things. I was just wondering, with the way the debt goes, I know we did the long-range financial plan, but doesn't look at exactly everything we're going to do in the future. Is there any room in there for if we wanted to do any, even not too major a project, to be able to finance it within the next 10 years? Or have we really locked ourselves in for quite a long period of time in what we could issue for debt?
Council always has the discretion to add more debt if they want.
I'm trying to stay within our framework.
What you're seeing there really is the increase in the debt that you're going to have in the next little while is related to the big projects, light rail. When we'll take that debt on, that'll increase
30 years.
Exactly. But the biggest pieces are actually in your water and wastewater area, because of the fact you need to make such significant increases in the infrastructure, and we don't want to increase the water rates dramatically. So we're smoothing it over time by using a little more debt in those areas. Every project is measured on its own merits, and am certain if there was something that council needed or wanted to do, and the only source of it was debt financing, the council of the day would consider it and look at that as an option. I think you still have room because we're at 7.45 against a 25% limit, and you're at 5% against your 7.5% limit. So yes, you probably still have probably have some room in the future.
Is that water and sewer debt going in long term too, or is it this thing? I mean, we used to do most things around 10, and that meant they'd be paid off, and then you could bring something else on. We're doing these long term ones, so they're not going to be disappearing for a long, long time.
One of the principles that you approved as part of the long-term financial plan is that we try to match the length of the debt with the life of the asset. So today's ratepayers are not paying for things that will benefit multiple generations in the future. So as a result, we have gone to longer debt with the water and sewer assets because they generally have a lifespan of 50 years or more. So we have done a lot of 30-year debt for those assets. Would we change it in the future? I think there's always that consideration to go to a shorter term, but the impact is that you're going to be paying, today's users will be paying more for those assets.
The roads usually are about 10 years because they wear out faster.
That's correct. We do 10 to 20 years depending on the magnitude of the
But I don't see in this, with the long-term ones we've got now, there's not going to be a lot, if to stay in the 7.5%, there's not a lot of room to make much change. That's what I'm hearing.
No, and the 7.5% is was a target that was adopted quite a few years ago, and council may want to reconsider it at some point in time.
It was before Lansdowne and before light rail.
Exactly, and before all of this major infrastructure was decided that you needed to undertake.
Okay. Okay. Thank you.
Are there any more questions? No. Okay, we have no more questions. Then I just move on to item 2. Sorry, on that item. All in favor? It's carried. Item 2, sinking fund financial statements. No more. Okay, questions on it? No. No one has that sinking feeling. All right. So is it carried? Carried. Okay. All right. Notices of motion for consideration at subsequent meetings. None of those inquiries. Other business? Anyone would like to move adjournment? It's moved by the Vice Chair. Carried. Next meeting is September 11th, 2014. So have a good audit summer. I should indicate that if necessary, at the call of the chair, there may be a meeting in the middle of the summer. I don't know. Okay, if anything happens to come out between now and then. Thank you.